Two dividend ETFs are quietly generating $5,000 every single month, while VOO investors are still waiting to sell shares just to pay their bills. This is about Schd and VYM and the income gap most people never calculate. But here's the part nobody talks about. The real advantage isn't the yield, it's something deeper, and it changes everything. If you're new here, this channel breaks down dividend investing, ETF comparisons, and income-building strategies in plain English. No fluff, no hype, just the analysis you need to make smarter decisions with your money. Hit subscribe and turn on notifications so you never miss a breakdown like this one. Almost every Schd versus VYM comparison gets it wrong. Most people argue about expense ratios. They debate sector weights. They compare trailing yields and call it a day. But none of that answers the real question. What does your financial life actually look like after holding one of these for a decade? That's the comparison that matters. And once you understand that framing, everything changes. Now, before comparing these two head-to-head, it helps to understand what kind of investor each one is actually built for. There are two archetypes here. One investor wants growth now, income later. The other wants income now, stability always. VOO leans into the first. Schd and VYM lean into the second. That design choice explains almost every difference you'll see going forward. Let's talk about what these funds actually hold. Schd tracks the Dow Jones U.S. Dividend 100 Index. It screens for dividend consistency, cash flow, and financial strength. Every holding has to earn its place. VYM tracks the FTSE High Dividend Yield Index. It casts a wider net, over 400 holdings, focused purely on high current yield. One is selective, the other is broad. That difference shows up everywhere. Now here's where the income story begins. Schd currently yields roughly 3.7%. VYM yields around 3.2%. VOO, just 1.3%. Imagine putting $100,000 to work. VOO throws off about $1,300 per year. Schd delivers roughly $3,700. VYM lands near $3,200. That gap feels small until you hold it for 10 years. But yield alone is only half the story. Schd's dividend growth rate averages roughly 11% per year over the last decade. VYM grows its dividend at around 6% annually. VOO grows at roughly 5%. So with Schd, the income accelerates. A dividend that starts at $3,700 annually doesn't stay there, it compounds. That's where the $5,000 per month number starts to make real sense. Let me show you what that looks like for someone, let's call him Marcus. Marcus puts $100,000 into Schd. He adds nothing, he just holds. After 10 years, his dividend income has grown from roughly $3,700 per year to over $9,000 per year just from dividend growth alone. Scale that to $1.2 million invested, and you're looking at over $5,000 every single month, paid to you without selling a single share. Now let's look at price appreciation, because critics always say dividend funds sacrifice growth. The data doesn't fully support that. Over the last 10 years, Schd has delivered total returns near 13.9% annually. VYM has returned roughly 11%. VOO has returned roughly 12.8%. Schd didn't just keep up, it outperformed VOO on total return while paying you 3 times the income along the way. That changes the math completely. Here's the 1-year, 3-year, 5-year picture. 1 year, Schd and VYM held their ground during the 2022 drawdown better than VOO. 3 years, Schd's dividend growth created compounding that VOO's yield couldn't match in cash terms. 5 years, the total return gap between Schd and VOO narrowed significantly. Each time frame, the income advantage compounds. Each reveal is bigger than the last. That's not an accident, that's the design working exactly as intended. Now let's talk about risk. Investors say they can handle volatility. Real drawdowns test that belief. During the 2022 bear market, VOO dropped over 19%. Schd dropped roughly 20% briefly, but recovered faster. VYM fell less, roughly 12%, because its holdings lean into defensive sectors like healthcare, utilities, and consumer staples. One leans into stability, the other leans into dividend quality. Both hold up better psychologically than a pure growth fund when markets fall hard. Fund size matters too. VYM manages roughly $76 billion in assets. Schd manages roughly $60 billion. VOO manages over $1.4 trillion. Very different scales, but liquidity for Schd and VYM is still excellent for individual investors. You won't feel any execution difference in daily trading. What the size difference tells you is who's using these funds. Institutions, endowments, and income-focused advisors park money in Schd and VYM specifically for reliable cash flow. That's not retail speculation, that's strategic income positioning. Here's the real payoff. The goal isn't to beat VOO on a spreadsheet, it's to build a life where money arrives every quarter without selling anything. Schd and VYM do that. VOO asks you to wait, accumulate, and eventually liquidate. That's a fine strategy, but it's a different life. If your goal is monthly income, passive cash flow, and a portfolio that pays you to hold it, Schd and VYM aren't just alternatives to VOO. For income investors, they're the better answer. If this breakdown helped you think differently about income investing, give this video a like. It genuinely helps more people find it. Share it with someone building towards financial freedom. And if you haven't subscribed yet, now's the time. Turn on notifications so you catch every comparison we drop. See you in the next one.